What's going on, everybody? Today we're going to be going over the Greeks, which are delta, gamma, theta, vega, and rho. So when picking an options contract, I always look at delta, theta, and gamma. Vega and rho are not as important, but they can be used to your advantage. So any change in any of these factors can impact this option's price. So first, we're going to be going over delta. Delta is the most important. Delta's domain is the price. It identifies how an option's premium may change if the stock price changes by $1. So in this instance, 0.45, for every dollar PayPal decides to go up, your premium price goes up by 0.45, and vice versa. For every dollar it goes down, your premium price goes down by 45. The thing about delta is it can also be used to estimate the option's probability of expiring in the money. So this 0.45 gives this contract 45% chance of landing in the money by the expiration date. So next we're going to be talking about gamma. Gamma is delta's right-hand man. It's delta's expected rate of change. So if PayPal goes up $1 to $2.84, the premium price will go up by 0.45. And then if it decides to go up another dollar, your delta will increase by whatever the gamma is. So this will be 0.48. So on that next dollar, your premium price will go up by 0.48. It's pretty simple. Now let's move on to theta, which is the Greek of time decay. Theta estimates how much value slips away from an option with each passing day. So the longer you hold this contract towards the expiration, the higher the theta will go. But every day you hold this contract, you will be paying 0.47 off your premium. So the next opening day, you're going to be paying 0.47 off that premium. Now, the one thing to remember about theta is that time decay works against buyers and works for the sellers. So the sellers get paid off the theta. Next, we are going to be talking about Vega. Vega's domain is implied volatility, which is right here. Vega estimates how much the premium may change with each 1 point change in the implied volatility. So if this changes by 1 point, it'll be 37%. If the implied volatility percentage decreases by 1 percentage point, the premium would be expected to drop by the Vega, which is 0.13. So if this implied volatility percentage goes down to 0.35, so does your premium, and vice versa. There are a lot of other factors that could cause a spike in implied volatility, which are earnings report, political conditions, news, and even the weather. Depending on the strategy you use, a spike in the volatility can be a blessing, a curse, or it can either have a small impact. So the further out an options contract expiration is, the higher the Vega would be. In other words, an option with longer expiration may react more in a change of that volatility. Now, let's move on to Rho. Rho is basically the little brother of the Greeks. Rho identifies how much an options premium moves if the interest rate changes. It's slow moving, so they have small impact. So all these are important to know when you're picking your options contract. The most important ones I would look at would be delta and theta. I hope this helped you guys out. If you have any questions for me, just leave it in the comment section, and please don't forget to like and subscribe.